So as someone that considers himself a low budget investor, every dollar that I put into my portfolio is super important when it comes to building a portfolio for long-term dividend growth and share price growth. And when a market crash happens, as it's been happening for a little over the past month now, it can be really painful. But there's a way to build a portfolio that can weather those storms. And in this video, I'm gonna give you guys 5 metrics that I pay attention to when I pick out dividend stocks and ETFs. Free cash flow, if I were to compare it to a person, is the money that you have left over after you get paid and you pay all your bills. It's the money you can pretty much do whatever you want with. And for a company, it pretty much works the same way, except there are typically 5 things that a company can do with the leftover money they have. They can use that money to pay off their debt. They can use that money to be a part of mergers and acquisitions. They can invest money back in themselves to contribute to R&D or to expand the amount of buildings they have. They can buy back shares, which would increase people's share price because it decreases the amount of shares in the market. Or they can use that money to give back to shareholders in the form of dividends. You can argue that when it comes to finding a really successful dividend paying stock, this particular metric is the most important. The more consistent their free cash flow is, or ideally the more consistently it's increasing over periods of time, the more likely that that position can not only consistently pay that shareholder a dividend, but consistently increase that dividend as well. And typically these companies also have a consistently increasing share price over a given period of time as well. Now, getting paid a dividend is really important. Getting paid a consistent dividend is more important, and getting paid a consistently increasing dividend is definitely the most important. This is why I said that free cash flow is kind of king when it comes to these metrics, in my opinion, because a company that can consistently pay and increase their dividend payouts to their shareholders is a company that has enough money to do so. One of the metrics I actually look at is the dividend CAGR, or compound annual growth rate. That takes the average annual growth of the dividend over a given period of time, taking into account compound interest. So essentially in this case, you reinvesting your dividends. I personally want to make sure that the dividend CAGR of a stock is higher than the average rate of inflation, which I know the Federal Reserve does its best to keep it at around 2% per year, even though the past few years have been a lot crazier than that. That just shows me and gives me more of an idea that the money I'm making isn't going to be worth less than the year that I'm in or in the future. The payout ratio is the percentage of a company's net income that's given out to shareholders in the form of dividends. For me, deciding on if whatever percentage of that payout ratio for that particular stock is healthy is really dependent on other metrics, including the dividend CAGR and the free cash flow. Like, you may be looking at a company with a PL ratio that initially looks high, but if in that same period of time their free cash flow is consistent or even increasing, and their dividend CAGR is also increasing and their share price is increasing, then you know that PL ratio is fairly healthy. Otherwise, I heard that most investors try to avoid a stock that has a PL ratio that's higher than 60%. You might even see a range between 30 and 55% as being healthy. Anything higher than that, especially 60%, might indicate that a company is starting to run out of money to consistently pay their dividends. They may drop their dividend payout. They might even stop doing it. So that's really something to be careful of. The next one, not just focusing on the dividend yield, but the yield versus its 5-year average. This is really important, especially if you are a low budget investor like myself. You may be really attracted to a stock immediately because of its dividend yield. That was me at one point in time, but that can be very dangerous. However, in times like we are in right now, where external situations are causing share prices to drop, this gives investors opportunities to invest in positions with a slightly higher dividend yield than it normally has. Like, if the share price of a company goes down for a temporary period of time, but that company at that same period of time has enough money to pay their same dividend, then the dividend yield is higher than it was. And a stock with a current dividend yield that is higher than its 5-year average, even during times like we're in right now, may be an amazing opportunity to invest into that position. Obviously, you want to look at some of the other metrics that we've gone over as well. The last one is debt levels, because low debt gives companies room to breathe during a downturn. In general, the less debt a company has, the better. Of course, there are certain debts out there that might be a little bit better than others, but regardless, if a company consistently has enough money to pay off their debts on a yearly basis, then that's a pretty healthy position. If they have enough money every year to pay that debt off more than once, and that's even better. For example, you can look up a company's free cash flow over a given period of time, and you can also look up their total debt over that same period of time and come up with a ratio of how many times that free cash flow could potentially pay off that debt. And at the end of the day, you're looking for a trend that's either very consistent or increasing, meaning they're starting to be able to pay it off more than once. Now, not every position is going to be perfect, but here are a couple examples of stocks you can look into that are going to to have some pretty positives when it comes to these 5 metrics. First, you have Johnson & Johnson. It does have a dividend yield of 3.15%, but its 5-year average is 2.75%, so that's one good check out. It does have a 10-year dividend CAGR of 5.88%, which basically means every year since 10 years ago, its dividend yield has increased by an average of 5.88% to get it to where it is today. What I really do like about this position is the combination of its PO ratio, which is under 50%, and its dividend growth of 62 years. This makes Johnson & Johnson one of the, I think, 50 dividend kings, meaning it pays and increases its dividend payout. I think it just consistently pays a dividend payout for at least 50 years, but this one happens to also increase it, so that's really cool. Also, the free cash flow to net debt ratio is something that's really cool to look into. It's over 1% from 2021 to 2024, aside from January of 23, and it has about an average of 2.372 times, which means on average, Johnson & Johnson can take all their free cash flow and pay off all their debts over 2 times. And all this helps supports their share price history, and it has a 10-year share price growth of over 55%. Another example, this is actually a company I'm kind of interested in investing into sometime in the future, is Domino's Pizza. Domino's Pizza has a current dividend yield of 1.34%, but it has a 5-year average of 1.05%, so that's already something pretty cool. It has a 10-year dividend CAGR of 19.45%, so even better than Johnson & Johnson. I think its 3, 5, and 10-year are also really great. It does have a lower dividend growth, but still a good dividend growth period of time of 11 years, and a PO ratio that is 36%, so even lower. So it's not using a lot of money to actually pay its shareholders, but it's still able to increase it over a given period of time. So its free cash flow to net debt ratio, when I at least looked into it, it wasn't that great. Since 2021, its free cash flow is roughly 10% of its net debt. So it wouldn't be able to pay it on a yearly basis. It will only be able to pay a fraction of it, which isn't great. But at the same time, they still have the history to show that they're able to still pay and increase their dividend yield, and it supports their overall share price growth, which over the past 10 years is over 300%. So that's something to keep in mind. At the end of the day, especially if you're a low budget investor, we all want to make sure that we accomplish our goal of having a portfolio that experiences long-term growth and long-term dividend payout growth. And these metrics will hopefully be a good start in doing that, especially in times like this where the market is making share prices go down and gives you a good opportunity to invest in discounted stocks. I've personally been investing almost 6 years now. It'll be 6 years in a couple of weeks, and even my portfolio has especially been feeling it, but I'm still investing into the stock market knowing that it's going to benefit me in the years to come. But to be a little more transparent, I did make this video to go over how my portfolio did for the month of March. Surprise, wasn't that great, but I go a little bit of detail because there were some good things that came out of it, so hopefully you guys have some time to watch that video. But I appreciate you guys watching this video, and until next time, as always, take care.